The Federal Reserve is the central bank of the United States. In 1913, Congress founded the Fed to give America a more trustworthy and flexible monetary and financial system. As time has gone on, the Fed's role in the economy has grown. Its main duties are as follows. Number 1. Forming monetary policy to achieve maximum employment, stable prices, and moderate long-term interest rates. Number 2. Overseeing banks to ensure stability in the financial system and to protect the credit rights of consumers. Number 3. Limiting risk in financial markets. Number 4. Providing financial help to depository institutions, the government, and foreign official institutions, while also taking part in managing America's payment system. The Federal Reserve has 12 regional banks. These banks are located in Boston, New York, Philadelphia, Cleveland, Richmond, Atlanta, Chicago, St. Louis, Minneapolis, Kansas City, Dallas, and San Francisco.
The Federal Reserve controls the three tools of monetary policy: open market operations, the discount rate, and reserve requirements. The Board of Governors of the Federal Reserve System is responsible for the discount rate and the reserve requirements, while the Federal Open Market Committee, or FOMC, is responsible for open market operations. Using the three tools, the Federal Reserve and the Federal Open Market Committee are able to influence the economy by either increasing or decreasing the money supply.
The Fed can change the money supply in a number of different ways. Number 1. Buying bonds from or selling bonds to the public. Number 2. Lowering or raising the reserve ratio so that banks can loan out more or less money. Number 3. By raising or lowering the discount rate, the Fed can alter the supply and demand of the loans that banks borrow from the Fed.
The Federal Open Market Committee deals with open market operations such as buying and selling government bonds. The committee consists of 7 members of the Board of Governors in the Federal Reserve System, the President of the Federal Reserve Bank of New York, and 4 of the remaining 11 Reserve Bank presidents. The Federal Open Market Committee releases statements to the press 8 times a year, most recently on January 30th, 2013. In this statement, the committee recognized the current state of the economy and proposed a strategy to deal with it. They announced this quarter that the economy was experiencing a pause in economic growth due to high unemployment rates and recent natural disasters. They also announced that the inflation was below the long-term goal. The committee then set its goal, aiming to foster maximum employment, keep prices stable, and raise inflation to the objective level. To do this, the committee decided to purchase additional Treasury and mortgage securities to increase the money supply, allowing for a better environment for employment and economic growth. However, the Federal Reserve could boost the economy more effectively by also lowering the reserve ratio and discount rate to increase the money supply further.
Last year, the economy expanded moderately. Household spending advanced, while business investment slowed. The housing sector remained depressed, but inflation subdued and appeared to stabilize. They will aim for a 0 to 1/4 funds rate, maintain programs to extend average maturity of its holdings, and maintain existing security holdings. Chairman Ben S. Bernanke, Vice Chair Janet L. Yellen. Other members of the board include Elizabeth A. Duke, Daniel K. Tarullo, Sarah Bloom Raskin, Jeremy C. Stein, and Jerome H. Powell. These members are appointed by the President and confirmed by the Senate. One term is 2 years long. The maximum time served on the board is 14 years. You can serve those 14 years non-consecutively. The chairman and vice chair are also appointed by the President and confirmed by the Senate, with terms of 4 years. The 14-year rule applies to them as well.
Well, let me tell you something, all that glitters ain't gold.